Joining us now on the ETF show to talk about performance, market concentration, and index rebalancing is MSCI's Mark Carver. Well, first, Mark, there's a perception that factors have underperformed the market in recent years. Which factor indexes are performing well this year?
Well, first of all, it's great to see you, Jenna. It's always nice to be here with you. And you're mostly right. Factors have had some performance challenges, but there are areas, particularly momentum, where we see very strong performance. In fact, the momentum indexes across all the flagship MSCI regions have outperformed year to date and over the last 12 months. So that's great to see. Market concentration is a big challenge for style investing. Many of your listeners, in fact, I would argue all of your listeners, they're well informed on this notion around market concentration. They understand that concentrated market can be the enemy of factor strategies. And while global equities are up 10%, US markets up even better, up around 11%, the factor indexes have some mixed performances. So momentum, like I mentioned, has performed extremely well. To put a fine print on that, USA momentum is up 23% year to date. It's up over 43% in the last 12 months. MSCI USA Quality is up 15.5% this year. It had a really strong 2023. That means the last 12 months, that performance has been up over 34%. Interestingly, these indexes have historically done very well in periods of central bank pause. We know that right now the US Fed is holding steady on interest rates. So that long-dated analysis of showing strong results in periods of pause for momentum and quality is repeating itself in this environment. I think it's also important that people know that outside of the US, we see a bit of divergence in the things that are doing well. In the US, people keep talking about momentum and growth, but outside the US, while momentum has done well in developed markets, we are also seeing some developed markets where value investing has done very well. What this means for investors is that macro divergence that we see across regions and countries is leading to style performance divergence. That allows investors to start to diversify across exposures as they're investing outside the US. This is a theme you and I have talked about in the past, but we're seeing that evidence, particularly notable around value. That's giving investors that diversification choice that we haven't seen maybe in the last 5 or 10 years.
And you mentioned market concentration. This is a topic we've, of course, discussed in the past. Are the markets still highly concentrated, Mark?
Yes, they are, and particularly in the U.S. market. So we've put out a couple of really great research pieces on this topic. The first was done in the early part of this year, where we looked at we call them the stars across Europe, Asia, the U.S., and we noted that in each region, there is some level of market concentration, but the profile of those names was not the same. So it was a very sort of a U.S., was a very tech-centric, or let's call it growthy type stars, but that's not the profile outside the US. More recently, the research team put out this really great piece that's called Can Crowding Scores Quantify US Stocks Fragility? Now, in that piece, we noted that the US market in particular, it's the most concentrated it's been in the last 30 years. And we saw this really across 3 areas. The first area was the weight of the holdings in the index. The top 10 holdings in MSCI USA accounting for roughly 30% of the weight in that index. The top 50, something like 50% of the weight. That's the highest in 30 years. The second area where we noted this is this notion of the effective number of stocks. You can think of that, Jenna, as a diversification measure where today the effective number of stocks in the US is at the lowest point it's been in 30 years. The third area is the sector concentration, where we look at technology and communication services having a combined weight that's approaching what we saw with technology and telecom back in the internet bubble 25 years ago. One bright spot potentially is the return contribution is not nearly as intense as what it was a year ago. You might remember at this time, or somewhere around this time last year, we were looking at the Magnificent Seven accounting for 75% of the returns of the US market. We don't see that level of return contribution concentration. And so that I think that's a positive sign. One thing the listeners can look at is the return of the standard indexes versus their equal weight peer. And as you see the equal weight indexes start to perform more strongly relative to the standard index, that can be a sign that that return contribution or return concentration is continuing to soften.
Now, you've referenced USA, momentum, and quality in your remarks as strong performers year to date, and the ETFs linked to those have been popular. But MSCI is going through a rebalancing cycle. How are these indexes impacted by the rebalance, Mark?
Well, those are two interesting indexes to look at because, yes, they have been popular with ETF investors, but they have very different profiles. So quality tends to be a slower moving, lower turnover index and strategy, where momentum is fast moving, fast turnover. So when we look at quality, for example, the sector neutral quality index in its rebalance, there'll be 25 names that are added to the index, roughly equivalent names that are deleted from that index. And because it is sector neutral, you will see some shifts in the weights to sectors. Specifically, technology will decrease by about 1.9%. Financials will be upweighted by a little over 1%. Momentum, there's a lot more action going on in the rebalancing of the USA Momentum Index. More than 50 names will be added to that index. More than 50 names will be deleted. But the real story that I think investors will be interested in is the sector changes. So technology, the weight of that in the index will be reduced in the index rebalancing, and financials will be increased. Now, that might surprise some people, but when we look at some of the standout performers over the last 6 and 12 months, you might see some of the U.S. banks like Wells Fargo and JP Morgan stand out. Those two names are going to be added into the MSCI USA Momentum Index. And if we look at their performance over the last year, they're both up somewhere in the order of 48, 49%, which is reflective of that increased, first of all, the addition of those two names, just as an example, and obviously that increase to the weight in financial names. So this is an important consideration for investors as they look to make sure that their overall equity program is properly diversified. So understanding that index rebalance and how it fits into the overall diversification of their equity investments is quite critical.
Well, thanks so much, Mark. Always great to have you with us.
It's great to see you, Jenna.
And thank you to everyone watching. Once again, that was MSCI's Mark Carver. And I'm Jenna Dagenhart with Asset TV.